Hi guys, welcome back. This is part 4 and the final video in the series on how to read financial reports. In this video, I'll be showing you how to read the balance sheet. So let's get right into it. The balance sheet is a snapshot of the company's assets and liabilities taken at a point in time. It tells the financial strength of the company and liquidity. It has two sections, assets and liabilities, and under each section there are current and long-term portions. Under the current assets, it starts with cash and cash equivalents. These are the cash and liquid assets such as short-term investments or marketable securities. Next is accounts receivable. It is the amount of money that customers owe the company. Inventories represent completed goods that have not been sold yet. Prepaid expenses are things the company has paid for but has not consumed. Examples include a subscription to yearly licenses that have been paid upfront and other current assets. These items are rolled up as the total current assets. Under the long-term assets come property and equipment, lease assets, goodwill, intangible assets, long-term assets, deferred income taxes, and other non-current assets. These items and the total current assets are rolled up as total assets. There are two types of asset classes, tangible and intangible. Tangibles are real assets with real value in the marketplace, such as cash, marketable securities, or property and equipment. Intangibles are assets that do not have any real value, such as goodwill and intangible assets. Goodwill is accumulated through acquisitions. Let's say the company buys another business A for $10 million and the tangible assets of business A are $6 million. The difference of $4 million is goodwill. Goodwill is included for accounting purposes and has no real value. That is why people like Warren Buffett will not include goodwill in valuations. Some companies will amortize their goodwill and intangibles over time, but most of them leave it in the balance sheet. Straight up, I'm interested in cash, goodwill, and intangible assets. Cash is a tangible liquid asset needed for the company to service its short-term obligations, in other words, liquidity. And this is measured by the quick ratio. The quick ratio is cash and equivalents divided by total current liabilities. A quick ratio of 1 or above is preferred, though there are a lot of companies that have a quick ratio well below 1. You need to see the historical quick ratio for the company. If there is a sudden drop in the quick ratio, the company might be running into liquidity problems and might have to take on debt to service its short-term obligations. I would like to see the goodwill and intangible assets below 20% of total assets. Qorvo's ratio is 46%, NVIDIA's ratio is 17%. Besides these items, I also pay attention to big items or big changes from the previous period. The current assets portion for NVIDIA has grown from the last period. There is a big jump in cash and marketable securities. It is either NVIDIA made a lot of money in this period or took on more debt. We'll come to these again shortly. Under the current liabilities lies the accounts payable, accrued liabilities, and short-term debt. Accrued liabilities are products or services that have been consumed but not paid yet. Under the long-term liabilities are the long-term debt, lease liabilities, and other long-term liabilities. I'm interested in the short-term debt and long-term debt portions and the trend whether growing or declining. As observed earlier, the increase in cash is most likely due to the increase in the long-term debt. I like to look for big items or big changes. The only big change is the long-term debt for NVIDIA. There are no big changes for Qorvo. The other item that most people miss out on is the commitments and contingencies. You must dig into this item as there could be potential expenses in the following quarters. There does not seem to be any significant expenses expected for Qorvo, but NVIDIA has a few large items. NVIDIA has purchase obligations of $4.59 billion over the next 12 months. It is probably an ongoing item, and although the number is large, it is just business as usual. The item I'm concerned about is litigation, but NVIDIA has stated they don't foresee any major issues here. Next, we come to the ratios. I have shared the quick ratio earlier. Besides that, I'm also interested in the price to book value. It is the price of the stock divided by the book value. Book value is the total assets minus the total liabilities, and it is preferable to minus the goodwill when calculating the total assets. Value investors look for a price to book ratio of below 5. The other popular ratio is the return on assets. It is net income divided by total assets. I like to see a ROA of at least 15%. With that, we've come to the end of this video series on how to read financial reports. You can also download the companion ebook from the description box below. Please subscribe if you have found this sharing useful. And I'll see you in the next stock analysis video.